Great. Okay, we are recording. So for those of you who won't be in here, of course, you'll be able to watch this again later if you want to watch it again. We usually share the recording within 24 hours. Today, as I said, expert ratings, unusual expert ratings. The sort of word about unusual expert ratings has been out there for many years. So we're going to have a little look at that scientifically. We'll run about 30 minutes or so on that, and then I'm going to hand over to David Wozniak, who's going to talk a bit more about the Fibonacci, pretty much for the rest of this session. So on my screen at the moment, can you just type Y in the chat box? I think you can see my charting area in here. I've got a chart of VeriSign up there. If you could just let me know if you can see that okay. Great, thanks, Wolfram. So expert rating. So when the system was designed, the rules that were built into the system were based upon an accumulation of events occurring on a decision tree process where if a particular event happened on one of the indicators that we were watching, for example, if it was a very bullish event, say on a particular indicator like MACD, if that event occurred, then that would add a certain weighting to or an accumulated total for an expert rating up or down. Once that event had happened, that would then trigger other indicators to go and look and see what their conditions were in. If there were more bullish tendencies firing on other indicators, that would add more weight to the upside rating. If it was bearish, it would add weight to the downside. That tree process had many branches, many different combinations of events that lead us to a high expert rating up or down. Now, the rating up or down, the rule of thumb is 95 up or 95 down is the significant event. For an expert rating to reach that level, we have had to have had quite a few different indicators fired. As many of you who have been in the system for many years will know, we have the ability to see the major events, not all of them, that actually have contributed to a given expert rating. So on this chart here with the ER button in the bottom left-hand corner here, if I click on that ER, you'll notice the vertical cursor here went back to the most recent rating. So in this case, it's a 97 up, 0 down. And as you know, we can hit on the ER expert rule button and it will tell us the major rules that fired. There are other rules that would have contributed to this, but these are the major weighted rules that gave us the 97 rating. For good and bad, that's the rating system. We have not changed the system. The ratings that apply to stocks or the slightly different system that applies to the market has not been adjusted for many years. We did change things back in the 90s at one point, and we have not changed it since. We don't believe in continually optimizing these systems for good or bad. This is what we have. However, back probably maybe 25 years ago, there was certain clients who were very interested in some of the non-high expert ratings and whether they had any significance. So in this session, I decided that we'll explore the ones that were most highlighted to us as being events that might have some significance. And we can do a little bit of research in here, and I've been doing that using Expert Design Studio and then creating color studies just to see what they look like on charts. So those of you who will have known, who know these ratings, the first one I'm just going to talk about a little bit here is 1656. Yep, there you go. 1656 is the rating. So I could change the search criteria on these buttons to just go look for 1656. What I've actually done instead is created a color study for it, just so we can see visually what a 1656 event looks like when it occurs on a chart. So, for example, everywhere on this price chart that is a blue bar is actually a 1656 event. So I put my cursor over to here, it's on 3:15:22, and that's a blue bar there. So a 16:56 event occurred on that day. You can see on this chart, and you can see on other charts too, for example, AKAM. There's 16:56s occur fairly frequently in different areas on the price chart itself. Are they significant? Is there something that is it tradable? Well, that's what we're going to find out. Before we do that, what does it mean? Is there any significance to 16:56? Obviously, not a lot of rules fired on a 16:56. So if I go to, for example, this one here, on February the 15th, and I hit the ER rule, there are just two things you'll see in here. And this is true of every 16:56 event. The first one is it's a bullish reversal indication, and it's based upon the exponential smooth average of price. And it just says that a rate of change is on this indicator that there's some accumulation taking place, and it could be this is a reversal point. The second one, and this is true of every 16:56 on stocks, the price phase indicator is moving to the downside, and it's a bearish continuation signal. So not a lot of information in there, but what we can do, of course, is that we can go out there and test not only 16:56, but some of the other ones. So first off, let's just look at 16:56. There's a second one that's been mentioned over the years, and I'm just going to go to chart settings and into color studies. I've set this up beforehand, and I do have this available. This 16:56 is the only study we're looking at the moment. If I disable that, the other one I'm looking at here is 5911. So this one here, if I enable that, let's change the color on that one, and let's make it a nice, let's see, 5911. No point in making it red since I already have red on the price bars, so I'll go with gray for the moment. And finish. So a color study, I will have an EDS file that I can make available once we have the recording done of this. That'll have these in there, as well as the EDS file that we'll be looking at in a moment. So changing this 16:56, 5911. So now we have these little gray bars. This is a 5911. When I put the cursor on 5911, we'll have a look at the expert rating on that. Notice again here, this is a topping out pattern and starting to decline. Again on the ESAs, and that's a bearish indication. The price phase indicator is moving to the upside. This is a bullish indication. Looks exactly the opposite of 16:56. Kind of interesting. So bear that in mind. We'll go look at one more, and then we'll dive into some of the analysis on this to see if these have any use for us in trading. So the last one, color studies. Let me switch off the 5911, disable that one. And the other one that's been mentioned is 1159. There are other ratings up there that I have not heard mentioned before. It's been used by some clients in the past and still being used. But this is another one. This is the 1159, not the 5911. So I've enabled that, and it's going to turn these into a nice pinky purple color. So when we look at this one here, again, this one's the 1159. And I hit on the ER button, have a look at what you get in here again. So in this case, it's again, it's the ESAs, it's the rate of change is bottoming out, and it's increasing, and this is a bullish indication. Whereas we get the reverse thing again with the phase. So all of these events have this sort of similar characteristics going on in here. So looking at a price chart, we just briefly looked at those three different indicator expert rating conditions. Not a lot of information we can glean just by looking at it. We need to have a look and see what happens when we do a bit of analysis on it. So what I did was I made myself an expert design studio file, which is what I used for these indicators. So I called this file an expert rating, and again, it's the launched from the studio, for those of you who haven't been in there before or it's been a while. I created a expert rating based expert design studio file. It's a bit of a tongue twister. I called it Not Your Normal ERs, which is what this session is about. So in here, on this rule library tab, anything that's got an exclamation mark in front is just a descriptor. So here's 1656, ER up 16, ER down 56. So I created really a rule. Go find any time that event occurs. I created one for 11:59, and I created one for 59:11, and the final one is the combination one. This is one of those combinations that I have seen used out there. It's using 59:11 and 16:56 together. Because of time constraints, I'm going to focus on 16:56 on its own, 11:59 on its own, and then the combination of 11:59 and 16:56. There's plenty for us to look at in here. I've created in this Expert Design Studio file here. Each one of these, of course, is a rule. There are 4 rules. Allows me to create 4 tabs, which I have created in here. Literally, you can just, when you do a report and you do insert, you're allowed to create tabs, one for each of the rules that are in there. So the rules that are in there, each of these separate rules, and of course the last one here, which I called yesterday 11:59, is the combination of 11:59 and 16:56. What I did was each one of these, I ran a back test just to see if there is any validity to these ratings as a standalone. So the first one, not your normal 11:59, I called it. So anytime an 11:59 rating occurred, you would have a stock appear. A lot of stocks actually appeared in this particular setup. So if I were to do this and decide, okay, I want to test this, I'm going to do this right now live, I can set myself up by clicking on report when I'm on this tab and go to new back test. So I'm testing 11:59. How am I going to test this? Well, first off, before I do that, I'm going to decide my database, which is, in this case, the S&P 500. So a nice standard database for us to look at. And we're going to stick with that SP 500 throughout the analysis and not change parameters. So here we're trying to just to see if there's any validity in rating. So we'll keep it as simple as we can. So first one, 11:59, I'm going to create myself a back test. So I go report new back test. It puts in the name of the tab in there, so it makes it easy for us to follow it around. I mean, this is a test. This is the report tab for if I was running it every day. I click on next, I'm going to go long. And this is, is this correct or not? We just test short. But in this case, we're going to try it long. We can do both directions, but at the moment, we're going long. I'm going to test back 24 months. That's a standardized period. You can see it there. I don't have data in here for 9/19 yet, so it'll probably run it just through to 9/15 for us. If it fires, I'm just going to buy at the open the next morning, and the same when it closes the position based upon exiting strategy, which we'll come into in a minute. So going to stick to a real simple standard money management exit techniques here. I'm going to pop on a trailing stop, protect 80 of my capital list, protect 80% of my profit above 5. So a real simple setup here, and just see if how this works. So when I click finish, I can go to test and then run, and click OK. And down the bottom here, it's running through its analysis. It'll go through a complete cycle of looking for those ratings, entry points, and an exit point. So we'll get an immediate idea if this has any validity on a macro scale. And it comes up really quickly on the screen there. So remember, this is the S&P 500 stocks over 2 years. So what are we looking at when you see this type of analysis? What's quite interesting is, number one, there's a lot of winners versus losers. there really is a lot of winners versus losers. This is a 2-year period. Remember, 9/18/20 through 9/8/19/22, through some pretty rock and roll times during the last 2 years. We know what's happened with the market. We know when it came out of the March low from the pandemic and what's happened since the beginning of the year. So that's a pretty interesting macro view here with this many winners and losers. And look at the average annual return on investment with this strategy versus if you just bought and hold the SPX or a surrogate for the S&P 500 itself. So on that macro view, it looks pretty good. This is a very simple money management system on this particular expert rating. Now, so the question is 2,908 winners versus 550 losers. That's almost 6-to-1 ratio. That's pretty good. There's a lot of trades, 3,458. So the first thing we have to make sure of is that there's not one of these cluster events, which is what can happen when you do just a simple back test. So in this case, I always drop into the positions here. Every single position that it fired and then exited will be in here. So this is really what happened. You can see number of days held, when it went in, when it got out, what your maximum profit was, what your actual profit was. So 2 things, just as a quick rule of thumb here, I always look at the entry date. I just click on this column to sort by that, just to make sure that we don't have, with that many trades over that period of time, did we have several days where there were like 100 or 50 entries in one day. And you can see immediately there are circumstances where, like here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, maybe 15 or 20 or 9/1. That's a lot of trades in one day. And I'm just going to scroll down here for a quick view. There's a few here, 7/14, maybe 10 or 12. Again, that's a lot on one day. 6/23 again. And I can keep going down the list looking for anything that might be an aberration, i.e. there was a particular day where we had a large number of trades on one day. So let's assume in this case that there was maybe 20 was the maximum. That's more than we could actually probably manage, or most of us would want to manage. And on any given day to try and put that much on, let alone do we want to use that much capital. So the second thing I look for is what's the maximum profits? We click on that column. Is there some like 3 or 4 that had hundreds and hundreds of % return? Well, there isn't actually. That's pretty good. I mean, obviously holding a position for 203 days was nice, 93 days, 91 days, but for some great profit. Nothing that was considered an aberration, not like a 10,000% position that might skew our results. So looks pretty good. Looks pretty good on that level. So what we're looking at here, let me just recap back into the summary. Remember the rating we're looking at here, when I go into File and so when I go down here, you can see the exit strategy is just based upon protecting my money. That's all it's based upon. When I go back into the report view, remember we're on this 1159 tab here. So all that rule is 1159, 11 up, 59 down. We went long. You'd think it'd be balanced the other way. Not a lot happening, remember, just those 2 mega rules that were firing. One was bullish and one bearish. 1159 looks pretty good. Let's go and take it to the next level, which is throw it into the portfolio simulator to see if we can glean some more realistic statistics out of it. So this was pretty good, right? I mean, it's a pretty good system, but that's a lot of trades. I mean, if you're talking about 230 trading days, so 460 altogether, that's a lot of trades to be making. You're going to be making 8 or 9 trades a day, maybe 7, depending. Some days more, some days less. So the next thing to do is to take this. Remember, this is this particular test. This is this 1159, and let's throw it into the portfolio simulator. So obviously I've been in here earlier, and I've been running some tests on different scenarios in here. The ones I already put in here, 1656, 15, and 911, we'll look at it in a moment. What I'm going to do is look quickly, not actually look at this one. I'm just going to take the settings for this and duplicate it. It just saves us a bit of time. So when I go into properties, so this is a simulation on the 1656. What I want to do is make it a simulation on the 1159. So I can do this just by changing the name and create a new version of it. What happens when I click run, because it's going to tell me, do I want to change that? Actually, we'll do it this way, go edit. Would you like to rename it? Yes, I would. Because the one thing I'm going to need to do, 1159, is tell it what my entry is. Remember, it's the 1159 rating, and this file has 4 different rules in here. So I have to match up the 1159 that we were just looking at, that rating. So everything else is copied from what I've been testing in the other accounts that we'll look at in a few minutes. So I've kept the rules the same, and that's when I keep that level playing field. So what does that mean? So for 1159 entry, same thing, trading stop 80, protect 80% of my capital, protect 80% of my profit above 5, just like we had in the EDS backtest. The additional layer that goes in here, of course, is the capitalization. I've set it to this level, 5% of my portfolio value in any one position. Makes sense for me. No more than 8 new trades a day. I used to keep that at 5, but I've got better at putting on trades, so I can do that. There's no problem. I'm buying at the open in this strategy, so I can fire off those trades fairly quickly. Come a morning within the first half an hour of the market opening. Next area here, no more than 10 open positions. That means I'm managing 10 positions that are open. Once I have 10 open positions, I can't buy any more, even if the rule says buy more. You might want to try that a little higher. This here, maintain capital reserve of at least 400. That's great too. So in this particular case, I'm actually using only 50,000. Often we just default to 100,000. But I was in a session for our UK folks the other day, and someone mentioned that maybe bringing it lower because they have investments doing other things with different strategies. Don't want to put all the money into one area. So 50,000 is what we're going to use. So I'm going to click OK. And when I click run, just to recap what's happening here, 1159 is going to fire. When it fires the next morning, it's going to jump in and buy any of the stocks that it can, obviously based upon how much money I have and how many open positions I already have. If it hits an exit as far as money management, it'll get out of the position before it starts buying. So if I was already in 10 positions and 3 of them exited, it'll exit them first and say, hey, I freed up that capital. I can use that money to go and buy 3 new positions, presuming the rule fired. And it ran it from start date of 9/15/20 to 9/15/22. So pretty much the same period that we did in the Expert Design Studio, but now we've got some real life constraints. So I haven't run it for this one because I just did the other ones. I'm going to click on run now. The difference here is down the bottom here, you've got pass 1 of 3. So it's actually going through generating entry points. Once it's figured out all that, it goes through the other passes to figure out money management and position. So it's doing the whole thing for us for that whole period. Remember, that strategy looked pretty good when we were looking at it inside Expert Design Studio. And there you have the results. When, hey, look what's different this time around. Same period of time, no thousands of trades, 118 trades only. And that's because I've told it I can only have a certain number of trades open at any given time. And the other thing that was important in there was, if I just jump back real quickly before we look at this into Expert Design Studio here and into the trades that we had on this, notice the number of days. There was quite a lot of times when positions were held for a significant number of days. So what that means is that we will probably have had weeks here and there where there were no trades at all because we were in trades that were making money for us. Not bad. So let's check out what this means. So instead of thousands, it's only 118 trades. So maybe we could increase the number of trades that we put on, or maybe we can have a look at that when we look at the positions themselves. As you can see here, the reward risk ratio is 2.08. That's pretty good. Our average annualized return. And remember, this period of time we're running from 9:15:20 to 9:15:22. That's when the market looks like this. We'll just run this into a weekly chart here. So this is what we're looking at here when I zoom this in a little bit. We're talking about this market that's gone from this period here to this period here. So we've had the bull run up and then we've had the move back down. And that's a weekly chart we're looking at. So that's the period we're testing the strategy over from what the market's done. So if you bought and held SPY as a surrogate of the market during this period, you'd have made 7.59%. You wouldn't have made any money this year, of course. While this strategy actually yielded almost twice the return, even during this period here. So 50,000 became $57,267. You know, it's not bad. And down the bottom here, of course, you have all of the things that contributed to this. So we know the rating that contributed to it. Everything is in there, and it tells you, of course, you know, the all of the other things as far as the file that was used in there. And again, you've got some internals in here, IRR, internal rate of return, and the total annualized in there as well. So not a bad strategy, not too many trades, 118 now. I mean, that's what, 50 a year, one a week. So pretty good though for an expert rating that had no significance, but it's an event that does occur. So let's go look at, instead of going into Expert Design Studio and what I did with this one and running the same thing for 1656 and for 5911, I have done those already so that we can have a look at that. So just to recap on this one, statistics analysis here, 14.68%, 118 trades, lots of winners versus losers. So just bear that in mind when we move to the next one, 1656. So that's the 1656 rating. What happened with this one? Pop into statistics. We click OK on this one. 111 trades. Remember, same exiting criteria, same period of time we're looking at. Not as good as you can see. Definitely not as good. 1.6% average annual ROI, same period. So you might as well just have bought SPY and held on to it. Same period, same amount of money, same exiting characteristics and for money management. So 1656, another rating alone, not so good. So not really interested in that one. So we know this one's pretty good, 1159. So what about 5911? Let's go into statistics on this one. 5911. So very similar to the number of trades, 122. But look at the return again. Same period of time over those 2 years. We might as well have just clung on to the SPY and rode out everything rather than try and trade all this. Didn't do very good over that 2-year period. So 1656 and 5911 alone, both of those didn't do so well. So this is pretty good. 1159 on its own that we just ran live here did pretty good. Let me shove a quick look in here, which is the first one here, and I'll just open this. Go to properties. Remember earlier I was saying we did the 1159, 5911, 1656, and then that double event. This is the one where you get 1159 and 1656, one occurring after the other. So this one I'd actually tested earlier. Same parameters as the other. So it's a double event. One happens before the other. 1656 happens afterwards. So in this case, I ran the test, same period of time. And the results on this one, not good at all. And we're talking, oh, sorry, no, this is the wrong one. let me go into this one here. I'll tell you why in a minute, because that's the, let me go to this one here. I'm getting myself ahead of myself there. Here it is. Here's the period, 20 through 22. Same period again. Similar number of trades, 129. So remember, this is the two ratings together, both happening one day after the other. Check this out, 18.48%. So it's better than that standalone one we looked at. 50,000 became 59,000. That's pretty good going. And remember, this is during the last 9 months. We've had a pretty brutal market, and we're going long just based upon that particular expert rating. So it's pretty good. Now, reasoning behind this, as I said, we're not going to investigate the reason why this is. This was pointed out to me some years ago, and I'm hesitant to actually ever talk about it because it wasn't part of the original design of the AI system. But in a case like this, when you get a combination expert rating like this, which is 1159 and the 1656 together, in that order, one day after another, no other criteria, this is what you get. This is what happens. 107 winners and 22 losers. That's not bad going. And again, we're just using simple money management exiting criteria. The drawdown, your maximum, your average drawdown is 13%. Yeah, you're going to have to write that out. The maximum profit and loss was 31%. So there's no aberrations as far as trades are concerned. It's fairly reasonable. And we again restricted the number of trades we could go into, 8 new ones in a day. This is 129 trades at 70, we're talking about 65 a year. So not too bad. We're talking about 1 and a bit a week. It's not bad at all. Again, by loosening some of the amount you could buy, you could probably do better and get more trades in here. But again, that's something you can experiment with if you're interested, and I can get you this Expert Design Studio file. So you can see the ratings themselves at 1656, 1159, 5911. All three of them on their own, not great, except for that one. And then we put them all together. We get these two together, at least. Then you get this fantastic return, really, for a rating that really doesn't have any real meaning as far as the original intent of the expert system. But this works. So one other thing I did in here, I just wanted to see what it was doing during this period when this bear market's been on board. So I ran this particular event from the end of last year, 12/31/21. Pretty much the whole year has been going down. And just to see what it was doing during this period of time. And yeah, and it's got winners versus losers. There's still more winners than losers. It's not doing great. Its average, its ROI is down 11.5% versus buy and hold 24.5% on the S&P 500. So your 50,000, if you had started the year at 50,000, you'd be down to 48,400 in this market. It's not too bad. I mean, yeah, you're still winning pretty much more than losers. The losers are obviously getting hit on some of those big market down days. There's no doubt. There is no doubt. But I wanted to see what it was like as far as you can look at any strategy during any fantastically good or bad period, and you'll get the results you expect, right? If you look at a strategy during a hugely bullish week, it's going to look fantastic. Look at it during a hugely bearish week and it's a bullish strategy, it's not going to look good. But it's good to see that this holds up fairly well. It's still ably beating the market during that period. So if you're interested in checking out this, really as I say, this is a unusual expert rating, something that we've never actually talked about in any session or in any seminars over the years or webinars at all. There does seem to be some validity to that combination one. It does have, some legs, as they say in the UK. So it's something that might be worth considering for some future testing. On the chart itself here, I'm going to go quickly in here. Good chart, go to settings, back to color studies. Remember 4 different segments we have in here. The one that we're going to stick with is this one here because it's the best. That's the one that does 11:15 yesterday. I'm going to disable this one and click OK. And so when the actual chart itself, put a doc up. Give me a second here. I've got an index. I want to do this one. And there's a buy right here. So it doesn't happen all that often. The bigger the database, obviously, it probably happened more often. There's a buy right there. So you can see 1656. There it is. It's the color bars turned green the day before. Guess what? 11:59. There's the buy day. Just happened to be a second 1656 right there. 11:59, 1656 buy. So this is a pretty interesting little study there. Again, these two expert ratings don't have a lot of information in the ER button when we clicked on them. But as we can see by running our simulator, this particular strategy, this one here, back to the statistics on this, 2 years, bullish and bearish period, did pretty well, pretty well. Any questions on that? Type them into the box there. I'll put together an email to everybody with this file and when the recording's available as well, so you can run through this again, because I've gone, not a high speed, but I know it's a lot to take in at times, and it's just we wanted to. Someone's been lobbying me for a while to do this, so I've done it, and they're right. There is some validity to, especially the combination expert rating that's nothing to do with the original intent of the system. So if there's no questions, or save questions, pop them in the chat later, that's fine. I'm going to hand over to David now. Let me stop sharing here. I'm going to make you host, David. Let's make host. There we go.
Okay.
All right, David, your host. It's all yours.
Okay. And so let me see here. Let me share my screen. And
yeah, we can see your screen fine, David, in the PowerPoint.
okay. And it's just the one. You're not seeing both sides, right?
That's correct. Yeah, yeah. You're on the presentation mode. Perfect.
Excellent. Let me get my pointer going here. My laser pointer. All right. Good. Well, thank you, Steve. And for those that have tuned in before, you already know who I am. I'm Dave Wozniak. I'm Chief Market Strategist at Trading Floor Research. In my past life, for about 33 years, I was in the financial industry, started in Chicago, worked my way up. Last a little over 17 years, I was a portfolio manager with Stifel. And a lot of what I talk about in my newsletter, as well as what I talk about in these courses here, are things that I used as a portfolio manager. These are the tools I used, and one of them, of course, is what we're going to talk about today, and that's Fibonacci analysis. And as a matter of fact, it was such a big part of what I did. If you've heard past talks that I've given, I've talked about my early entry technical indicators that I used as my buy and sell signals for industry groups and individual stocks. And these are my rules. And the final rule, or the final factor that I used, was Fibonacci expansions for both early entry and exit points. So again, where am I exiting these trades? Not, on the way down in a lot of times, but I'm exiting a lot of my trades on the way up, therefore trying to maximize on my capital appreciation as the trade materializes. And that's what we're going to talk about today. So where we're going to start is we're going to start with I guess, to get a baseline for everybody, let's just talk about Leonardo da Fibonacci. And he was an Italian mathematician, lived from 1170 to 1250. What he was really well known for was a book that he wrote at the time, a math book that he wrote at the time called Libra Bocce. In Libra Bocce, two big things he did. Number one, he brought the Hindu Arabic number system to the Western world, to Europe and Western Europe. And he, as a, of course, as Italian, brought it to Italy. And the other thing that he did was he created this number system, which got his name on it. And it's called the Fibonacci number system. Now, how does this differ from just using the Hindu Arabic number system, 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, repeat? This is how it actually works. And again, this is review, I'm sure, for a number of you, but again, just to get a baseline here, how the system works is it starts with 0 and 1 as the typical number system we use. But from there, what you're always doing is you're taking the last two numbers and adding them to each other to get the next number. So 1 plus 0 gives you 1, 1 plus 1 gives you 2, 2 plus 1 gives you 3, 3 plus 2 gives you 5, on and on and on. And you just keep going along there. Well, along with that, once you get to about the 10th and 11th iteration, you actually get to, and you divide the 11th iteration by the 10th one, or you take the 12th iteration and divide it by the 11th one, and on and on. You take and do that, you are going to end up with this 1.618, or what is everything. You can look at even the human body and the different relationships between the parts, or distances of your arm from your elbow to your shoulder to your hand. All these different areas carry this 1.618. And the theory behind this, of course, is if it appears everywhere in nature and the stock market moves on human emotion and also a part of nature, then why wouldn't this also work in the stock market? And what I have found is that it does. Now, I have personally read, and I don't think I'm exaggerating here, I have probably read over 100 different books on Fibonacci numbers. And what's interesting about each one of those is that each one gives you just a little bit unique way of applying these numbers. And none of them, for me, came out quite right. They never really kind of hit the mark. And I kept trying and trying and trying. And again, I'm always just messing around with charts. I'm always just, on my computer, just trying different things. And all of a sudden, one day I hit on a way of applying Fibonacci analysis that really started to hit the numbers. And again, nothing is 100%, but the way that I use it now, it really, really hits on very, very well and has enhanced my trading tremendously by using this. And that's really where we're going to go with this today. We're going to talk about 3 different ways that I actually apply Fibonacci analysis. So the first thing, of course, is this idea of the 1.618. Now, what I'm always doing, and this is a key here, there's 2 ways I'm always applying this, but one of the ways is I always take the latest base that, in this case, I'm using Cogent Biosciences, which happens to be a stock that I recommended. This was my buy in July in my newsletter. This happens to be a stock that actually we're still holding at this point in the newsletter. And I bought it, of course, coming out of a wonderful base, cup and handle type base. And once it broke out, the first thing I want to know is typically where I'm going to set. You're going to see this commonly in my research, is one of the first target areas that you're going to see happens to be at 1.618 coming out of the latest base. So what am I saying by that? I'm taking the high of the base and the low of the most recent base, and I always just want to see where 1.618 comes in. And what's interesting is, of course, this was my first target area, 15.55, which actually wasn't too bad coming from about, the high 9 area, not too bad. But here's what, putting it all together, what I look at. So again, I didn't take anything off of it at that point, because how does the price react when it gets to that dollar area? Well, immediately you can see the day that it actually even came up to the dollar area, it closed above. Then you closed below for a couple of days, and then you just stayed here and based above this number. And that's actually where we're even sitting today. Closed, I'm not even sure, somewhere in the high $15 area today, maybe 15.88 or something like that. But anyway, we continue to base. As bad as this market is, we're basing above this very important number. And as long as we continue to base there, the idea is then it's going to go on to my next Fibonacci target number. In this case, at least one of them up there is 22.82. I've got another bigger number in front of that, and I'm going to show you how I get to those bigger numbers, which actually comes in closer to 20. We'll get to that in a little bit. But this is definitely one area that I'm always, just a simple area. I always want to see where 1.618 comes in, and I want to see how price reacts to that area coming out of a very, very sound base. Now, the next thing that I do, though, is what I also want to do is along the way as this stock, and we're gonna use Cogent, but as this stock is progressing along its path, what I want to do is, again, stocks don't move straight up and they don't move straight down. Typically, they move in waves. And this might be a bigger wave now that we're resting from, but these are kind of ripple moves. And what's interesting is every one of these moves, how you can go back to this Fibonacci number system again, is you can pull these numbers out of it. And the three biggest numbers I'm always looking at for retracement are 38%, 50%. This one is absolutely huge, is 50. I'll even be talking about that a lot more even in today's course. But and then 62%. And again, each one of these are derived by dividing the numbers by each other in the Fibonacci number system. What I do with this, though, too, is I combine this then with moving averages. And the biggest one I'm always looking at is the 10-day moving average. Why do I look at the 10-day? Because the strongest of strongest stocks will pull back typically to the 10-day moving average at some point. Good, solid trending stocks will pull back to the 20-day moving average. And as far as where institutions will always be buying, is they're going to be buying off the 50-day moving average. I also combine that a lot with trend lines, whether I use trend lines for time frames. We'll talk a little bit about that. And I also use the trend lines for pullbacks, or what would be known as a throwback into the trend line. And so taking that all into account, let's go back to our Cogent position here. And as Cogent was even coming along and setting up the handle of the base, what you could see is that you get that impulse wave, and then you get that pullback. And in that pullback, what you're going to see is initially, what did it do? It pulled back to 50%. And what I'm talking about here is from the beginning of this impulse move to the high of that move, it pulled back about 50%. In doing so, another important thing happened with this stock. If you draw a nice little trend line on this, I always look for this, that nice throwback into the trend line. But you're going to notice a third thing that happened with this. It also pulled back to around the 10-day moving average. And all of this in combination, why I look at this, why I'm always looking at this as a portfolio manager, why was I so concerned with this? Because what this allows me to do by concentrating on this, of course, you're getting your buy signal and your crazy update right here. But I say this all the time in my classes I give, or even in my newsletter, don't go chasing, and especially don't go chasing stocks in this type of market environment. Don't go chasing. Stocks move in waves. And what will happen with this is a lot of times when they shoot up, they will pull back. But the question is, where are they going to pull back to? That's what all of this answers. The combination of a 10-day moving average, the Fibonacci retracement, and in a lot of cases, that beautiful throwback into the trend line just sets you up beautifully for where you can time this thing better for what I love to call low risk entry. And so that's what I'm trying to do when I use these Fibonacci pullbacks in combination with other technical indicators. So of course you get this impulse move, you get a pullback. And then what happens? Well, after that pullback, from the low of this pullback to the high of the next impulse move, what does it pull back to again? 50%. In this particular case, look at where it even came down to. Came down, oh, by the way, I use 10, 20, and 30. I talked about this in past classes I've given, webinars I've given. That's the moving averages I love to look at. 10 simple, 20 exponential, 30 exponential. Where did it pull back to? The 30 this time, in combination with 50% retracement again. And again, this is all about, as this progresses, we're not buying it when it's extended. And by the way, when it was even extended up here, look how extended on that day we were from the 10-day moving average. That always spells tremendous risk for me. Now, in this particular case, we really weren't even that extended from the 10-day. And therefore, we really didn't even get that much of a pullback in this either. But when you get super extended, you can be pulling back to that 10-day. And again, especially in the kind of market we're in right now. So the next impulse move took you from the low of that next one all the way up to the high point. And where did you pull back to now? So far, looks like we pulled back to about 38% retracement on that. So and here's the additional thing about that. Then you can say, okay, this is something I always look at also, is we talked about that 1.618 expansion number. Well, the 1.618 expansion number combined with this most recent pullback area, look at what we have here. And I love this. This is what gives extra support to the price, is a confluence of fib numbers that are coming together at any point. And that's what's giving you some great, great support in this trade right now too. So the next thing we're waiting for now, of course, is another impulse move that's going to hopefully be breaking this trend line and sending us higher. And right now, it's still under very good accumulation. Of course, bios are one of the strongest relative strength industry groups in the market right now, still keeping a lot of strength with that. And so this trade has, even with this horrible market, it was slightly higher today. And so you're seeing tremendous relative strength in that kind of a stock right now. The next thing I want to show you is what I love to do when we're in bases, or when we actually have had some kind of a big move, and then we're looking for breaking that move up into eighth increments. And I call these, based on the guy who came up with this idea was W.D. Gann. So I just call these Gann grids. And so what we're looking at on this is taking the chart and breaking it up into eighths: 0, 1/8, a quarter, 3/8, a half, big one, 5/8, 3/4, 7/8, and 1. Here's the thing about the eighth numbers is it's just not the eighth number itself. It's what each one of these eighths represent in strength. That's the important thing, because that is what gives me a lot of the predictive power of where price has a high probability of moving next. So let's just use some examples here, and I'll kind of go through some of the predictive power that I'm talking about with these numbers. So this is the S&P 500 since we topped out and bottomed in June. And I didn't pick up the last couple of days. I made this slide over the weekend, so we don't have the last couple of days here. But in general, you've got the general idea of this. And what we're looking at here is what I did, and I just love to do this all the time with charts, is that entire move from high to low, I break it up into eighths. And again, every one of, so again, I start at 1/8, a quarter, 3/8, a half, 5/8, 3/4, 7/8, and 1. And the interesting thing is, first of all, let's start with this. The strongest numbers, this is very, very important in the whole eighth series. The strongest numbers are 0, 50%, and 1. That is your strongest areas. So when I say strongest, I mean when price hits any of those areas, that's where you expect the greatest. If you're moving up to that area, you're expecting the greatest resistance. If you're moving down to the 0 area, you're expecting the greatest amount of support. Now, here I want to really focus on, first thing I want to focus on is 50%. 50%, I'll always refer to this in my newsletter too, as the bull-bear. It's a bull-bear war that happens at 50% of the range. So in other words, when price is trading below 50%, I say the bears are in control. So whatever range, a major range like this, below 50%, the bears are in control. Above 50%, the bulls are in control. Plain and simple. And to give up control at 50% is a big, big deal. And first thing I'm going to point out is it was very interesting. The market was, this last rally, the market was moving up with some nice momentum. Of course, not on a lot of volume, but it had some very nice momentum attached to it. And the bulls actually took control for about 5 sessions up here. And on the 6th session, they were just right on the line. But here was a giveaway that really, really confirmed things for me. When you gap down away from that bull bear number like that, that told me on that day, decisively, the bears have retaken control of this stock, and don't mess around at that point. That's how impactful 50% is. So what did we do in combination with other technical indicators? Well, they rallied us up to the 200-day moving average. They also rallied us right up to about the downward sloping trend line. But to me, the biggest part of telling the story was this bull bear struggle, well, 50% from the high to the low. Now let's kind of look at how we got to that number, which is also very, very, it means a lot. So in other words, the second strongest number in the series of the eighths is both the quarter and 3/4 number. Those are your second strongest numbers. So once we rallied up off of 0, off the bottom, where did we get hung up? We got hung up at a quarter. Totally makes sense. I mean, that's a strong number. Why wouldn't you stop at a quarter before you start going up? Here's where it got a little bit more predictive telling though for me was right in this area where it stopped at an eighth. And you can even tell I do this intentionally with my eighth numbers. You can tell that I make an eighth and 7/8 lighter than the rest of the numbers. There's a reason for that. These numbers are the weakest of the 8 series. And if price can hold that number like it did right in this area, it immediately tells me so much about where price is going. There's a high probability that if the 8th number is acting like a brick wall, typically price will at least get me back to 50%. And sure enough, that's exactly what it did. And you can start looking at charts yourself, start analyzing this. I'm telling you, these are the simple little tricks. Just watch these 8th numbers. They tell you so much. So what did we do? Now we've got some high octane here because price is holding up at the weakest numbers, at the weakest number, which is 1/8. What did we do then? Oh yeah, we took out a quarter very nicely, came back and retested the quarter number, came up, took out 3/8 like it wasn't there, gave you a little retest at 3/8, and then we went for the big one, the half. And guess what? They even tried to push you above half, like I said before, but couldn't get it done. The bears stayed in control. This tells me so much about what the S&P 500 is doing. So now as we're making our way down, look what they do. They take us straight through 3/8, okay? Right down to a quarter again. Guess what? Quarter is a strong number. Okay, so they held us up there on that first round lower. And then what did they do? Brought us up to 3/8 and left us with an island above the 3/8 number, came back down. Now let's put this in a combination with a trend line here. So now we've got a trend line off the bottom. This is where they left us hanging on Friday. Here was my thought going into this week. My thought was seeing this market rally, which we got up to about 39 yesterday, and today they sold us off again. I'm still wondering if they can get us back and do a throwback into at least 39.32. Why? Well, again, it just seems like a high probability case to me that maybe they might even use the Fed report after the Fed speaks tomorrow and gives us what they're going to say. They may try to rally us quickly up to that area, or they may do it before the Fed announcement. But I'm just going to tell you, I'm watching 39.32. Why am I watching it? It's a strong number. It's quarter, and it's in combination with a throwback into the trend line. So this is the area, I highlighted this in my newsletter over the weekend. This is where I'm looking at the trade, maybe moving to. And I'll tell you, if I get some sells off of that number, I'm going to be taking my downside positions and actually putting even more on. Right now, I've got things in the newsletter. I've got things like the SPXS. I've got the REW going for technology. I've got different things. I may just add to that trade at that point. So we're going to see what they do with the Fed announcement. But key on this number, watch what they do around 39.32 tomorrow. That's where I'm keyed myself. And again, they may even try to take us, I don't have it up here, but I have another big number at 39.45. They may try to get us even as high as 39.45. Somewhere in this area, it just looks like a throwback to me. We'll see what happens before they take us lower again. But end result for me, I'm still seeing things lower. Why am I seeing things lower? Let's use the same idea. Now, I did a webinar about this about a month ago, talking about the market. And again, if it's a great video to watch, if you want to watch it, it's based on a 155-month cycle, identical cycles. By the way, each one of these The 1987 crash ended at 50% from the low to the high, again, breaking it into my grids. What did it do again I'm sorry, this was 1987, 50%. In 2000, what did it do? 50%. And now we've had our 155-month cycle. 50% is down at 2742. Why do I think it's a high probability? Nothing is certain, but why is it a high probability that we could get to 50%? Is the same idea I was just telling you about. Look at what we did on this. Topped out in January. I talked about this in my newsletter. Where did we end up going down to here? Well, we ended up going down into the 3,700 area at the quarter number. That makes sense. Quarter number is a strong number. Why wouldn't we bounce off of that number? Well, here was the key for me, though. Not only did these down markets, these bear markets after 155 boom market cycles told me we went to 50%. What's interesting is this one kind of tipped a little bit more to me, telling me, you know what, there's a good probability this one's going to do the same. Why is that? Look at this tail on last month. Where did we go to? Hit it like a brick wall. We hit 4,300. What was 4,300? The 1/8 number. Whenever you hit it like a brick wall, what's the highest probability? You go to a half. And where is a half? 2742. So we'll see, but that's why my targets now are set on 2742 right now. It all is dealing with these eighth numbers, and I'm just putting probabilities together. I just deal in a world of probabilities. Everyone that's listening knows there's no certainty in the stock market. And the other thing is the other thing you have to always compensate for when you're talking about in especially the S&P 500 is Fed intervention. Do we get to a point somewhere along here where the Fed does intercede and start doing some option buying at the CBOE or something like that, that they try to use some of their techniques to stop the downward push of a market. I've seen this so many times. It does exist. And so, but in a pure market, which I have to tell you, so far, I've been pretty impressed with the trading of the S&P 500. It really seems like there has been very little Fed intervention to me. And so it's been trading very, very pure from what I've been seeing lately. So we'll see. But that would be in a pure market, high probability. If this was a stock, I'd be looking for it to get down to about 2742. All right. Here's a stock I just put in the newsletter. Again, it didn't confirm yet, but it's setting up with a tremendous what I am seeing. And again, this right now is a very strong industry group. I'm always looking for industry group strength. Relative strength wise, this is number 3 out of 197 is U.S. exploration and production. The amount of institutional buying in this stock seems huge right now. Even finishing up with Friday was a great accumulation day as the market was getting smoked. This thing was getting accumulated. And where's it getting accumulated? Let's pick it apart. Here's from the high to the low. Of course, I'm going to put my grids in there. And then I'm going to get my expansion. Where's my 1.618? At 960. I do have a big number. We're going to talk about how I get these big numbers. I got a big number at 910 in front of that, though. I'll tell you, that's the last thing we're going to talk about here. But in between that, let's take a look and see. How did this stock bounce around its eighth numbers as it was setting up? Well, it gets down to its 0 area. What does it do? Rallies up to a quarter. Yeah, quarter's a strong number. I'm sorry, got up to 3/8. And 3/8 is a semi-strong number. It's okay. And so it comes down and actually just about gets back down to 0 here and 0 again. And just about. And then it comes up, and what did we do? We took out the quarter number. And what did it do? It kind of rested very nicely on the quarter, but didn't want to take out 3/8 again. Rallied up to 3/8 and came back down and retested that quarter area. Now, in the meantime, look at this beautiful trend line that was set up on this thing. But understand, the bears are still in control right here. We are under 50% of the range, not to mention the fact, so 671 is 50% of the range. I've got a big number at 663 also. So what do we have right here? We've got confluence. This is a confluence area. So this is going to serve as stronger resistance as well as stronger support. What did we end up doing though? All right, well, we came down, we broke the trend line. This time we actually closed above 3/8. But here's the key. What did we do between here and taking out 50% and my big number? We gapped it. Always look at when you're taking out these big numbers and 50%. When you're getting a gap move on that, that is a very, very strong sign from the market, whether it's gapping down like we talked about on the S&P or gapping up against it like we're talking about right here. So what does it do? Well, they rally it. What did they do? Nailed 1/8. Uh-oh, not good. What is that telling me? You nailed it like a brick wall. That's telling me we're probably pulling back to a half. And guess where they immediately took us back to? A half. But look at how we've tailed off of a half. This is now setting up our handle. Look at how nice our handle's setting up at that confluence of Fibonacci numbers right now. And today, again, closed a little higher on it, but we still haven't broken that downward trend line. That is where my key is. And so I'm looking for 30-minute confirmation, and I'm looking for that 30-minute confirmation to break that trend line. Once we do that, I'm going to put my positions in, and we'll see if we can get, again, my first target areas are 910 and of course 960. Why 960? It's 1.618 out of that recent base. You'll always notice on my charts too, if you see them in my newsletter, I'm always going to show my big numbers in blue, and I'm going to show the other, the most recent numbers in gray. That helps me keep track of everything also. So always these big numbers have a big, big impact. And that's what we're going to talk about right now. How do I get to those big numbers? So this is how I do it. Again, let's go back to our Fibonacci number system again. And again, we talked about how we got the golden mean. We just took 55 and divided by 34, or 89 divided by 55, or 610 divided by 377. But as you keep working up, and as a shell unfolds, or any of these things in nature unfold, these Fibonacci numbers expand. So how do you get these expansion numbers? Well, instead of just taking 89 and 55 and getting 1.618, you can also take the next number up, 144, and divide it by 55. And guess what you're going to end up with? 2.618. Take 233, divide it by 55, you're going to get 4.236. Take 377 by 55, you're going to get 6.855, and on and on and on. And this is how you get the Fibonacci expansions. Okay, so this is what I'm putting in. That is where I'm ending up with these big numbers. And you can even see on this, 6.63 is my, or this is the 11.09 expansion number at 6.63. This is the 17.945 expansion number. This is the 6.855 expansion number based again, based on, again, we were talking 6.855, 11.091, and 17.945. Those are my expansion numbers. Now, the big trick is where do you put those expansion numbers in? And this is where I wanted to use ChargePoint. This is a stock I actually had in a newsletter when it was setting up out of this IPO base. But the reason I wanted to bring this one up now is there's a lot, you'll see there's a lot of unique things that ChargePoint did that it just serves as a great example to show again how to really use this Fibonacci expansion idea. So the easiest thing to do, so this stock IPO'd back over here, and then it started to go sideways into its basing area. Well, during its sideways motion, of course, it came down and hit the low. And you can see very nicely that you came and hit this low and put in a nice little handle. Where did the handle form? Well, the handle formed above 50%. We always want to know where that 50% is in our range. And again, as soon as we got above 50%, what do we know? We know the bulls are in control, and that's important. So now the bulls quickly went into control. And how did we get this again? Well, we went, oh, I'm sorry, that isn't from this. How we got this is a little bit different. So how we did this is the key of how I buy these stocks. So, and this is the part to take in right here, because this will not, you will not see this in any, well, I don't know, maybe you will see it in a textbook, because there's been so many textbooks written about Fibonacci numbers. I personally did not read this anywhere. This is something, again, I just did as one day I saw this and I just saw how great price responded to this. And this became my standard way of putting in Fibonacci expansions. This was my general rule of what I started to do. So once a stock hits its ultimate low, like ChargePoint did and that's the thing, I want to say this, to do this, I'm using an IPO right here, ChargePoint, when it IPO'd just a couple of years ago. But in order to use this, sometimes you got to go back. I'm going back on charts into the 90s, into the 80s, into whenever these stocks set up as IPOs, wherever the low point is on this chart. Now, the nice thing is, I do have to tell you, in the oil stocks, a lot of these oil stocks hit all-time lows in the past, couple of years. So it actually makes it a little bit easier with some stocks, and we'll get to that in this example too. But the whole idea here is based on the low, wherever the low is in the entire chart of the stock, find the low point. And the first swing high, the first high point that it hits, that's where you're going to put your 100% mark of your Fibonacci expansion. The first swing low after that ultimate low, first swing high and first swing low, that's it. That's where I set my numbers every single time. And that's how I set it in this particular case. You can see how it started bouncing off these numbers right away, got held up in this area, got held up, pulled back, got held up, gapped the number right here. And what did that gap actually lead to? That led to an explosive move to the upside. And you can see the way this stock was vibrating, rallied up to this area, rallied back down, rallied up to the area, broke out, rallied up, came down. Now, what you're going to notice is the other things that I do on this chart is you're going to notice my gray lines in between on this too. So let me see, did I include that? Hopefully I did. I didn't include that in this chart, but here's what I'm going to point out to you. From the high to the low of your first base, I'm going to put in my gray lines, my 8s with the expansion numbers. And I'm not sure why I took that off the screen here, but anyway, I probably just wanted to make this a little clearer for you. But you can see them on here. My gray lines they're pretty much matching up with the other ones. So you've got a lot of confluence on this. But here's what I'm going to tell you. Here's the example as we move along on ChargePoint. So now ChargePoint rallied up and it went sideways again. all the way into November. Well, in that sideways movement, that built a whole new basing area. So in that basing area, you can see, I drew it in nicely for you to see, you built a whole new cup and handle base with the handle, of course, forming at 50% of the range, as it should, as a proper handle. But what I do is all the time, the next thing I'm always going to do is I'm going to take that most recent base and I'm going to do the same thing again. I'm always going to attach a high and low and put my Fibonacci expansions from the most recent base. And that's what I did in this particular case. So now I've added those Fibonacci numbers. Look at what we've done. Rallied all the way up, just under the Fibonacci expansion numbers again, came back down, used my number from the most recent base at 2.618, caught on to that, rallied back up to the fibs, came back down. You could see the way this thing's bouncing off these numbers. Look at this, the way you finally got hung up on the number up in this area, a belt hold taking you down. So basically on this last number up, you barely closed above it on this big move higher. And so now we're now, you know, and again, we're very extended on this thing at the same time too. So here's the next thing that I'm looking at on this. So now I'm looking at how extended we are. I don't have my moving averages in there for you, but I can tell you we are very, very extended on this thing also. So I'm sitting on the edge of my seat right now. I'm looking at when are we going to be selling against this? And sure enough, it comes back down, closes underneath this number. Now, for me, that's good enough, especially because we took out the trend line in this area. And but as forgiving as the market is, what does it do? Tries to rally and throw back into the trend line, give you one more chance against the number. Can you see how these numbers are holding up, though? And here's another key of putting things together for me. So now we come down, look at what we do this time. We tail against these big numbers right in here, but look at where we're tailing. I want to point this out to you too. This is a key technique I'm always using, and I'll point these out in my newsletter too. Where I get trend lines coming together, good solid trend lines coming together at a point, those points are typically giving me very nice time cycle turn dates. So now I'm getting a combination of hitting this Fibonacci target area on a time cycle turn date, and I am tailing away from that by the end of the day. That, to me, is a done deal. I'm done with the stock by that time. But let's move on and say, okay, if you want to keep holding on, what do we see next? Well, my drop dead sell signal always is a 20-day closing low on stocks. That's a drop dead for me. I don't care if a stock came up, you know, had the cure for cancer, and you just told me about it the day before. If this thing closed with a 20-day closing low, I'm done. That is a drop dead signal. How do we get there? We gap the trend line. They throw us back into the trend line one more time. But look at how this thing is using these numbers now on the way down. We're using the same fib numbers on the way down. But in addition to that, I'll get back to those fib numbers again. Here's what I'm going to also tell you. You can use the same idea as I used at the very bottom. Now that we got a 20-day closing low, a definitive sell signal, what I definitely do is now, if I want to keep watching this thing, I'm going to take and put from the first low after the all-time high, I'm going to put my fibs, and I'm going to connect it with the first high after that highest high. That first high point, that's where I'm going to connect my fibs. So from 100 to 0 again, and I'm going to expand this to the downside. And you can see, look at the way this rallied back against 1.618, got held up, Didn't really get anything there, but we can probably find some information on the other numbers that I use. Look how we held up at that point, and look at how we actually really kind of muddled right around that 1294 number on the way down. Let's put that in combination with our other numbers that we used on the way up. And again, look at how these numbers just bounced off of this thing beautifully all the way on the downside here. Here's where it gets interesting though, and that's why I especially wanted to use this as an example. What did we do right here with this stock? We hit an all-time low a few weeks ago. We hit an all-time low on this stock. What happens with all of these numbers that I used ahead of time? If a stock hits an all-time low, these numbers are all gone. They are not used anymore. What has to happen is the whole thing has to repeat again. Here was our all-time low. Here was our first high after the low, first low after the low, and now we build our expansion numbers. Here was our first base after the low, and look at what we've done now. Now look where we're at with this thing. 1.618, look at how it took us right up there. Here's our big fib expansion numbers. Look how we're resting above. We hit 1.618, coming down to the big fib expansion numbers. Look at this, from 50%, what did we do? This is huge. This is actually what made me look at the stock again. I started noticing, once I see this, I'm going to tell you the clue that I looked at that started making me look at this. And again, I wasn't even looking at this thing all the way down. But these are the clues that I start looking at things. This trend line, whenever I see a major trend line break like this is beautiful. This makes me want to look at the stock again. But look at how it treated. Once it rallied up to this trend line numerous times, what did it finally do right here? Came down, the bears were actually in control. Look at this major gap this thing did to take out 50% and this massive trend line that marks the whole high to low on this thing. This is what made me look at this stock again. Not only that, we did it on awesome volume that actually gave me a buy signal on this very day too. And what did it do? Triggered up from there, rallied up to 1.618. Does that surprise me at all? No, it doesn't. And then what did we do? Came back down to test the 5/8 number, right back up again. And here's where we find ourselves. This stock is getting stronger and stronger and stronger. And again, these are the areas that, and by the way, up-down volume ratio during this whole thing, this is a key for me. These are things I'll talk about in other sessions, but I'm not showing volume with you today, but volume is such a big part of what I look at. The up-down volume ratio hit a 100-day high. That is a big, big signal for me. 100-day high as this was all happening. That is telling me institutions were pouring into this stock. And then again, it's getting stronger and stronger. What I'm looking right now is I'm building my list of stocks that I'm looking for. Once this market does bottom out, what I want to focus on is relative strength. I don't want to be bottom fishing. I don't want to be buying stocks that are down here when the market is down there. I want to be finding stocks that have already turned, setting up in bases. We're actually seeing big money flow from institutions moving into these things. This, to me, with everything I'm seeing right here, this is a great candidate for me to be watching. This will probably end up being in the newsletter at some point after this market actually does bottom out for good reason. The other thing that you can do to this again is from that high to that low. The other thing you can do is put your eighth numbers in there again. Quarter number, 3/8, half, 5/8, 3/4, 7/8. So in the big picture of things right now, understand that as good as this thing's looking right now, in the big picture, The bears are still in control here. Understand that. So when this thing rallies up to about 29 bucks, this is going to hit a wall right here. The bears are not going to want to give up control easily on this thing. Look what it did right now. Where'd it rally up to? Where'd it rally up to? Quarter number. Does that make sense? Yeah, it makes sense. That's tremendous sense right there, because what is that telling you? That's a strong number. You're having some kickback against that number right now. Look at what it also is doing though. Now I want to key in here. The 8th number is down around here. So we're going to see if by chance they kick it down to the 8th number and try and do a throwback, try to get it down to the 8th number, maybe in a market flush. Be watching for that. See how the stock actually acts. Is it a brick wall at an 8th? Well, if it is, we could easily go from an 8th to 50% very, very quickly on this stock too. So these are all the keys. This is what I'm looking at. These are the things I kind of wanted to highlight with you. One more example, just to show you too. Here's grayscale Bitcoin. And again, these are my big numbers. I put these numbers in way back from the beginning of the Bitcoin move. And I'm just going to tell you, look at how this stock, here was your sell signal, 20-day closing low on the stock. Look at how it took out its number at $43.85 on this. Not only that, you took out the 50% or 50-day moving average at the very same time. This was a tremendous short, just right in this area right here. What did it do? Came down, held up at its first number. Look at how many times you bounced off the 50-day moving average, came all the way up to that number, tried, and this is almost what I'm seeing for the market right now. Look at what you did here. You threw back into the trend line right at a major number. What did it do from there? Well, it bombed out, as you can expect, came down, held up at the next number, gapped the number, held up at the next number. Then what are you doing? Now this is getting interesting. Today we closed under 1189. We've now been getting some closes above this number. Look at how price has fought that number. But at the same time, in fighting that number, what did it do? Rallied up, threw back into the trend line, and now it's getting weak. With breaking that number, people are calling for the bottom in Bitcoin right now. I'm here to tell you, with breaking 1189 right now, my next target numbers on GBTC are 812 and 579. So we'll see what happens on this. But right now, GBTC is not looking good at 1189. These are my next target numbers down. And that's pretty much it. That's what I have for you today. If you even go to LinkedIn or Twitter at the TFRTrader, I post different things. As a matter of fact, tonight I already had posted on there about where I see the bond market going. I had that in my newsletter over the weekend. You can pull up some of those things. I'll post on some of the things I say in my newsletter, but you can follow me in those areas too. But again, subscribe to the newsletter with Steve at AIQ site. And also you can find me on some of these social areas too. And that's it.
Great. Thanks, David. And thanks, everybody, for being here this afternoon or this evening. We'll have the recording out to you as soon as it's available. See you all next time.
Thanks, Steve.